Hello traders, welcome back to the Forex Kick. In today's video, we are going to be talking about multiple time frame trading strategy. You will discover why top traders analyze different time horizons and how this approach can dramatically improve your trading results. This method will show you how to spot high probability setups, identify market reversals early, and time your entries with precision. Stay tuned as we break down this exact process that will transform your trading approach and help you capture more profitable trades. First of all, we will begin by understanding how price moves across different time frames. The forex market operates in cycles. Major trends contain smaller trends which contains even smaller price movements. As we can see, the daily time frame is actually would be our higher time frame, and it's a major trend. As we can see from this area, it's trending to the downside before it decided to break the trend line, and is breaking towards the upside. And we can also see that we are building series of lower lows and lower highs in the market. If I use my highlighter tool, we can see lower low, a lower high, a lower low, a lower high, showing us that we are in a down trend. This is basically what the market is trying to tell us of. The higher time frame strategy, the daily time frame reveals major support and resistance zone that other traders are watching. Remember, the higher time frame always reveal the major resistance and support areas that all the traders, major traders in the market, are also watching. This becomes your strategic point for potential trades. Look for a clear trend line, key price level, and major swing points. After we highlight such areas, we move down to the 4-hour time frame. Let's highlight these areas. These are the areas I'm looking for in market. We would go to our 4-hour time frame to find an accurate trade setup. Since this is our downtrend, let's analyze using this current downtrend of the market. So we'll go to the 4-hour to observe what the market is doing. There this is where you will spot potential entries while staying aligned with the daily time frame. This is where we will spot potential entries while staying aligned with the daily time frame. Notice how price reacts at the major levels we identified on the daily time frame. Areas where we identified, these are the support and resistance area. Where price broke below, retested it, and continued going down. When price broke below, retested it, and continued going down. This is how price reacted from this area. We would also use our 1-hour chart as our execution time frame. This is where we would enter our trade. This is where our precision matters. You will find optimal entry points with tight stop loss while maintaining the context of a larger time frame. So in this particular area, let's assume that we are looking for price to break this particular area, this particular support on the chart that we marked from our daily time frame. So if we want to capitalize on this trading opportunity, we would have to wait for price to break this area. When price break this area, remember that our sole focus will be on price action on the lower time frame in this particular area. So we would go to the 1-hour time frame, which will be our entry time frame. When we get to the 1-hour time frame, we can see that when price has broken the area and retested this particular area, let me make this clear for you. When price retested this particular area, we can see price retested this area in a trend form, making series of its own higher highs and higher lows, trending towards the upside for this pullback phase. And when we see price is trending to the upside, remember that the idea of this trend is to take the trend continuation, which was the bearish trend from the higher time frame. If we want to take this continuation, we would have to look out for our bearish signals, which is as price has first of all broken our support area, it has become a resistance area. But for us to take the trade, we can look for our entry signals such as a double top. A double top can be one of the entry signals to take your sell trade. If you do not know how to use the double top, you can watch our double top and double bottom video in our channel. You can use your double top or double bottom. In case you do not want to use the double top or double bottom, you can use your trend line break. You draw your trend line where price was respecting the trend while it was going up, and once price breaks the trend line, you can decide to enter your trade. Not only that, in case you don't know how to use your trend line break on the lower time frame for your entries, you can use your candlestick pattern. Once you see price trending towards the direction, you look out for your bearish candlestick pattern form at when price has broken the trend line. You can see there is a bearish engulfing candle here, even one towards this area. You can decide to take your trade off this confirmation for your entry time frame. This is how we combine our time frames to make sense while trading using this our multiple time frame strategy. There are some common mistakes we need to avoid. We need to examine some critical mistakes that we need to avoid when implementing multiple time frame analysis. The first crucial mistake we need to avoid is overcomplicating your analysis. The first major pitfall is analyzing too many time frames simultaneously. You need to just work with three key time frames: your trend time frame, your trigger time frame, and your execution time frame. Like what I did, my trend time frame was my daily time frame. From my daily time frame, I went down to my trigger time frame, which was my 4 hour, to give me a clearer structure of what market was doing at that particular area. Then I used my 1 hour time frame as my entry time frame. Adding more would only lead to confusion and analyzing paralysis. So you need to just stick to three. If you are a short-term trader, you can use your 4 hour, your 1 hour, and your 15. You just need three time frames that complement each other. The second mistake we normally make is neglecting the primary trend. Many traders make the mistake of confusing or focusing too heavily on the lower time frame, like this area where we were trying to take the trend, when we saw that the 1 hour was trending to the upside in a bearish market. When we see stuffs like this, always have it at the back of your mind that the overall trend was a bearish trend. We need to look for selling opportunities. There is no need to be taking a buy trade in this area. This is what we need to avoid, making overcomplicated trend analysis. So just stick to your higher time frame trend and trade according to that trend. The third mistake we always make that we need to avoid making is incorrect time frame selection. Your time frame should have enough separation between them. Using a 15 minutes chart with a 5 minutes chart provides little additional insight. Instead, maintain a factor of 4 to 6 between your time frame you are choosing. You just need to use a time frame that has a gap of 4 to 6 factor between them. Like you can use your daily, your 4 hour, and your 1 hour. That's 1 hour to the 4 hour is a gap of 4. From 4 hour to daily is a gap of, and so on and so forth. You just need to maintain a gap of 4 and 6 as the case may be. For scalpers, you can make use of your 1 hour as a higher time frame, you can make use of your 15 minutes, and you can make use of your 1 minute or 5 minutes as the case may be. Alright traders, we have come to the end of this video. The multiple time frame analysis is your key to identifying high probability trades. Remember, respect the higher time frame trend, keep your analysis simple, and ensure proper spacing between the time frame. If you found this video strategy valuable, hit the like button and subscribe. Turn on your notification bell so that you stay updated with more trading insight. Thank you for tuning in, and until next time, happy trading.